Thank you everyone for joining us. I'm Mary McNulty, the co-leader of Holland and Knight's tax controversy team. We have tax controversy lawyers across the country and in Mexico. Our panelists today are all in Dallas, except for Jim Dawson, who is in West Palm Beach. So Abbey, Garber, well, Jim Dawson, starting with Jim, he has tried cases in the tax court with the Internal Revenue Service and has been in private practice for a number of years since then. Abbey Garber has 30 years of experience with the Internal Revenue Service in the area that handles partnerships. And then Lee Meyercord, she's a frequent writer and speaker on partnership audit rules, and she also knows the substantive area of the partnership tax law. So I'm going to turn it over to Lee now to kick off our discussion of IRS partnership audits. Lee?
All right, thanks, Mary. Let's go to the next slide if we can. Okay, so we're excited to talk to you all about partnership audits, one of our favorite topics. We're going to start with Abbey and I talking about the status of partnership audits and recent IRS initiatives in hiring in this area. Then we'll talk about pre-audit considerations, and for our transactional folks, this section is for you. This is going to focus on the partnership representative, the all-powerful partnership representative, and their authority and things you might want to do in your transactional documents to restrict or govern that authority. We'll talk about whether you should elect out of those rules and considerations in making that election. We'll talk about the administrative adjustment request, or AARs, which is the equivalent of a partnership amended return. They can't file an actual 1065X, but they file an administrative adjustment request. And then we're going to turn to audit considerations. And these are key issues to keep in mind or things to do during the audit. So we'll cover some statute of limitations issues. That's Mary's favorite topic. We'll talk about imputed underpayments and when you might have a surprising imputed underpayment. We'll talk about modifications, how to get kind of the partnership level tax reduced in the modification process. We'll talk penalties and pushout elections. To keep this fun, we're going to have some polling questions. I'm sure Abbey will make a couple jokes. I think we even have a cartoon. This is going to be as lively as a tax presentation can be. All right, with that, I'm going to launch our first poll. Let's see if I do this successfully. Okay, so 2018 partnership audits. Of the 4 million partnership returns filed in 2018, how many partnership returns were audited? A is 140, B is 1,400, C is 140,000, and D is 1.4 million. So I'm going to give everybody a minute to answer. Okay, it looks like the answers have slowed. So far, we have no takers for 1.4 million. You all know the IRS better than that audit rates are lower. The correct answer is actually A, 140. So not the most popular answer. Oh, I'm sorry, let me end poll so you guys can actually see the results. Here we go. All right. So here were the results. So 3 people got it correct at 140. The majority thought it was either 1,400 or 140,000. And I'm sure the IRS would love to get to 140,000, but they weren't there in 2018. But we're going to talk about how that's all about to change. Okay. All right. So with that, let's go to, okay, is this the next slide? The audits are coming? Yes. All right. So we just talked about how rarely the IRS audits partnerships. In 2018, only 140 out of 4 million. So that is 0.003%. And even when partnerships were in fact audited, they were audited under these prior rules that we would call the TEFRA rules. And the TEFRA rules, there was a centralized partnership level audit and then centralized partnership level litigation. But assessment and collection happened at the partner level. So the IRS sometimes didn't pursue all the adjustments because even after they completed the partnership level audit, it wasn't worth tracing through the adjustments to the ultimate taxpaying partners because perhaps that taxpaying partner's share was so small. As you can imagine, the IRS has faced a ton of criticism for this, including by TIGTA, which is kind of the inspector general that audits the IRS and Treasury, with a particular focus on the discrepancy between large corporations, which have a much higher audit rate, and large partnerships, which have a very, very low audit rate, as we've discussed. There's even been kind of some mainstream press talking about the low audit rate for partnerships. There's a New York Times article last summer titled Private Inequity, talking about how rarely private equity funds are audited. Now that we've convinced you that perhaps this is not a relevant presentation because audits are very rare, we're going to tell you why that's about to change, and you should stay tuned for the whole hour. So there's been really 4 key reasons that audits are about to increase, 2 of which are on the slides. So the first one is the BBA partnership audit rules, which have made it easier for the IRS to audit partnerships. And Jim is going to cover in just a minute why that is and how those are better rules for the IRS. There's been a big increase in hires for partnership audits. Last year, there were a number of positions available that the IRS filled in the partnership audit space. I was just on a panel with some government speakers at the Federal Bar Association, and the first 5 minutes were kind of an infomercial on how there's still partnership positions available and they're hiring. And as Abbey and Jim can tell you, it's a great place to work. So they're continuing to staff up and ramp up. The third is really the increase, and for those of you who are CPAs, you've probably already seen this, the enhanced partnership reporting requirements. So for example, the obligation now to report negative tax capital accounts. And the third is, for the first time in a long time, there's really bipartisan support to increase IRS funding. And while much of that is going to go sort of to taxpayer service, so you could actually get somebody on the phone when you call, some will certainly go towards enforcement. And with that enforcement, we can expect, based on the emphasis in Congress on high net worth individuals and their partnerships, that partnerships will be a priority of the IRS. Okay, with that, I'm going to turn it over to Abbey to talk about the Large Partnership Compliance Program, which is a recent initiative.
Right, and that's directly related to the increase in partnership audits generally. So what is a large partnership, and how will large partnerships be selected for audit? Well, the IRS will use factors similar to those they use to determine large corporations: asset size, revenue size, volume of foreign activities. They will also use factors from the Schedule K1. And once they have this LPC, large partnership compliance population, identified, the IRS is starting to use data analytics to determine which partnerships pose the largest compliance risks. And in addition to data analytics, they also have a human classifier who will take a look at tax returns to perform a deeper dive of risk analysis of the returns. Then the IRS is going to use the information they get from initial audits to refine the criteria for selecting future partnerships to audit. They're going to feed the information into a machine learning function to better identify which partnerships to audit. So who will be conducting the LPC audits? You have some revenue agents who've been auditing partnerships for a long time. They will primarily serve as audit coordinators, but we know there's not too many of them around. As Lee mentioned, the IRS has been doing quite a bit of hiring, and they have picked up some agents with partnership experience, mostly for public accounting. They also have current revenue agents and new hires who have no partnership experience, and they can have those agents focus on the issues that are not partnership specific. And all of the agents are receiving training in the BBA procedures. The audits of 2019 returns started last October. So maybe the last slide shouldn't have said the audits are coming. It should have said the audits are here. There's some recent IRS guidance that the IRS issued, which is public, on the implementation of the program. And I will try to put a link in the chat to it if I can copy and paste while we're talking. Jim, I'm going to turn it to you to tell us a little bit more about the BBA.
Well, thank you, Abbey. The next 2 slides will give you a high-level overview of the BBA, and then we will get into more detail. Like TEFRA, the audit is conducted at the partnership level. Unlike TEFRA, the tax may be assessed and collected at the partnership level. That is, tax is collected at the highest rate in effect. Current partners bear the tax, which may not be the same partners for the year being audited. There are alternatives as to these 2 points. Like TEFRA, the IRS only wants to deal with one person on behalf of the partnership. That person is now known as the partnership representative, not the tax matters partners or TMP. The PR, the personal representative, has sole authority to make decisions. The BBA changed the requirements for who the person is and how that person is selected and terminated. We will be discussing the PR in more detail. So now on to the second polling question.
And Lee, you are on mute.
Here we go, guys. I think that was me talking myself through how to launch the poll, which we successfully did. So what is the reviewed year? The options are the year the audit occurs, the year the adjustments are taken into account, the tax year under audit.
It says here, host and panelists cannot vote, Lee.
Oh, I'm sorry. Yeah, you're not going to get to sway the results, Bobby. Okay, we've got, looks like the answers are slowing, so I'm going to end the poll so everybody can see the results. The correct answer, Jim, do you want to tell the masses?
Sure, the correct answer is C, the tax year under audit. Ah, see, they know this issue already.
All right.
All righty, so on to the next slide. So the imputed underpayment is the biggest change in the BBA because it is the first time that tax is computed at the partnership level. This slide goes through the options on how the partnership may request that the imputed underpayment be reduced to reflect the tax positions of the partners. Some modifications are simple, such as rate modification and accounting for tax-exempt partners, and these adjustments are made to avoid the highest tax rate from being imposed. There are more cumbersome options like amended returns and the pull-in procedure. As to the pull-in option, if a partnership owes tax due to IRS adjustment, the reviewed year partner could pay its allocable share of the adjustment without needing to file an amended return. The partnership can reduce the imputed underpayment paid in by the partners. The partner must make the payment within 270 days of the NOPA, which we'll get to shortly, and provide the IRS the necessary information to substantiate the proper amounts were paid. Is this the same as an amended return? Well, not really, and we'll discuss that later. All of these modifications allow the imputed underpayment to more closely reflect the tax that would have been owed had the partnership and partners originally reported the items correctly. Bottom line, Pushout Election shifts the tax burdens to the partners who were in the partnership for the year giving rise to the adjustments, but they pay the tax on the current year return.
Okay, so I'm going to take this one because this was my great idea to share this very patriotic chart with you all, which when I originally suggested, I think Mary thought it was a joke. It was not a joke. I think it's actually.
I thought it was overwhelming. It's overwhelmingly. You need to walk us through this. Yes.
That's right. It's very overwhelming. So I did not create this chart, so I can't take credit. The IRS did this, and it is, when studied, actually very helpful. Although I agree that my initial reaction was probably the same as Mary's. So at the top, you'll see it walks you through the filing, audit selection, just basically the BBA centralized audit process, right? So how you get selected, the audit process, and then what happens post-audit. You'll see the second row below that is timeframes that you need to keep in mind, and these are relevant timeframes for the taxpayer. For example, how many days the partnership representative has to request a modification, how many days the partnership representative has to make a push-out election, which Jim just mentioned, and we'll talk about in more detail. And then you'll see the very last line, taxpayer notifications, and that goes through the various notifications that the partnership rep, and in some cases also the partnership, can expect to receive during the audit. Now, this is available on the IRS's website. I'm sure everybody wants their own copy. And along with this, you'll find that the IRS is trying to put out a lot of guidance and answer questions. And it's all, the best place to look is really the website. They have updated the IRM. So now the Internal Revenue Manual has some guidance on BBA, but there's a special BBA page on the IRS's website that really has, the most up-to-date information. So if you have a question and you need guidance, particularly if it's regards, to a form or a process-oriented question, that's the spot to go. Okay, with that, I'm going to turn it back over to Jim.
Okay, now that we've convinced you, hopefully, that partnership audits are coming, and given a high-level overview of the BBA, and thanks to Lee, shared that wonderfully patriotic roadmap for you, we're going to talk about what you should consider or know before the audit. I'll turn it over to Mary to talk about choosing the all-powerful partnership representative and perhaps constraining that power in the partnership agreement and the election out. Mary?
Thanks, Jim. Yeah, the partnership representative has the sole authority to handle the partnership audit, so you really need to choose carefully. So who can the partnership rep be? First, any person designated by the partnership, but they have to have a substantial presence in the United States. And that means this person needs to be available to meet in the United States with the IRS, have a US street address, a US phone number, and a US taxpayer ID number. But unlike TEFRA, this person does not need to be a partner in the partnership. The IRS wants somebody that they can contact and who will make themselves available to meet with them in person. And so the intent here is to facilitate a productive environment for the administrative proceeding. So if you designate an entity as the partnership rep, the partnership then must appoint a designated individual to act on behalf of the entity. Because again, the IRS wants someone they can talk to face-to-face. I think we're getting back to face-to-face one of these days. So the partnership appoints both the partnership rep and the designated individual, and then names both the partnership rep and the designated individual on its tax return each year. So if a partnership decides to change either the partnership rep or the designated individual each year, that means a multi-year audit will have multiple PRs and designated individuals. So think about that before you change your partnership rep. So as Jim said, the partnership rep's actions are binding on the partnership and on all of the partners. That's both the current and the former partners, and as well as direct and indirect partners. So they're going to buy, the partnership rep will bind all those people in terms of extending the statute of limitations, entering into a settlement, agreeing to partnership adjustments, making a push-out election, any of the things that we're going to go through today. So if you would want to, or you may want to limit the impose limitations in the partnership agreement on what the partnership representative can do. That's great. And, we encourage, we do that in our partnership agreements, especially if we're not representing the partnership representative, but you just need to be aware that the contractual obligations or limitations that you impose in the partnership agreement have no impact on the IRS. So if the partnership agreement requires a unanimous consent of the partners to enter into a settlement, but the partnership rep goes ahead and enters into a settlement with the IRS without obtaining the required consent, that settlement agreement will be enforceable by the IRS. In that case, the partners would have a breach of contract claim against the partnership representative, but they would have no remedy against the Internal Revenue Service. So how do you change your partnership rep? The important thing to keep in mind is you can only change your partnership rep once a partnership audit is underway. Before then, the IRS doesn't want to be bombarded with different forms, multiple forms changing a partnership rep and a designated individual when the IRS only cares once an audit has started. So once the IRS has commenced, once the audit has commenced, The partnership is going to have a 30-day period before the partnership rep is notified of the commencement of the audit. And that 30-day period gives the partnership time to change the partner rep designation. And this is especially helpful if the IRS has commenced a multi-year audit and the partnership has different partnership reps for each of the years. All right, Jim, I'm going to turn it over to you to see if there's any way out of these partnership audit rules.
Okay, thank you, Mary. The second periodic consideration is whether the partnership should elect out of the BBA rules. So an individual, a C corporation, any foreign entity that would be treated as a C corporation or domestic, an S corporation, or an estate of a deceased partner is an eligible partner. IRS issued guidance last November that Q-subs are not eligible partners, like disregarded entities. A corporation cannot hold its interest through a disregarded entity or another partnership if it wants the partnership to elect out. So in counting to 100, count the K-1s issued for the year, including the K-1s issued by the S corporation. IRS has received many questions about electing out after the return is filed. The short answer is this cannot be done. An election out must be made when the return is filed. So what should you think about when deciding whether to elect out? Well, does the partner want to be audited directly? Well, there's a component of cost. There's a component of dealing with the IRS. There's the issue of control. Do you want the control to be with the PR or with the partner? Does the partnership agreement, as Mary was discussing about, even permit the partner to even handle the audit and payments of taxes? So how many partnerships have been electing out? Look at the slide, not many. So I'll turn it over now to Abbey.
All right. So now we're going to talk about administrative adjustment requests, AARs. A partnership that wants to make an adjustment to a partnership related item has to file an AAR. The partnership cannot file an amended Form 1065. And if the partnership files an AAR, the partners are bound by it. So in the AAR, the administrative adjustment request, the partnership has to calculate the imputed underpayment. And then they can either pay that with the AAR or push out the adjustments to the reviewed year partners. So Lee, if anybody missed that earlier poll question, what do we mean by reviewed year?
That is the year under audit, although our audience did very good on that poll question.
Glad to hear it. So again, the partnership could pay the imputed underpayment, or they could push it out to the partners from that year under audit. The partnership can reduce an imputed underpayment with certain modifications, but not an amended return or closing agreement modifications. There's no IRS approval necessary for modifications. If the partnership pushes out adjustments, there's no hot interest and no limitation on a net decrease. So instead of having poll questions, I'm doing pop quizzes. Mary, what do we mean by hot interest?
Hot interest is the cost of a push-out election, and it's the federal short-term rate plus 5 percentage points that would be paid by the reviewed year partners. It's calculated from the due date of the reviewed year return until the tax is paid. So it's just a cost of the simpler push-out election.
Okay. And finally, as you can see at the bottom of this slide, taxpayer favorable adjustments must be pushed out to reviewed year partners. So on this slide, you can see we've got a cartoon that says IRS, in God we trust, all others we audit. Now, Lee picked the slides, but I pointed out to her, when I was the IRS, I trusted lots of people. I trusted my mom, my buddy Steve in the office next door. That's about it. All right, we'll keep going.
I'm sure Jim's got a similar response.
Probably also a very long list. So we talked about what to know about before the audit. Now we're going to talk about things considered during the audit. We'll start by walking through the notices and things the partnership representative needs to do in response to each notice. Again, highlighting the importance of who you choose as your partnership representative. We'll discuss statute of limitations, which Lee pointed out earlier is Mary's favorite topic that you want to keep in mind. We'll talk about unexpected imputed underpayments, which could be a trap for the unwary. And finally, we hope to get to issues that could arise during the modification process and the limitations on push-out elections. Okay, so Lee, take it away.
Yeah, so before we jump into some, the notices of the audit and kind of the to-dos or things to consider at each stage, we want to talk real briefly about kind of hot enforcement areas that the IRS is focused on for partnerships, so that you know whether your client or whether your company perhaps has one of these issues and then will be on the IRS's radar. So the IRS has long been interested in issues relating to private investment funds. So this, of course, is management fee waivers, carried interest, monitoring fees paid by investment funds to portfolio companies. All of those have been a focus of the management fee waivers, certainly have been a focus of the IRS for a while, and then carried interest are relatively new. Those, of course, were enacted in the Tax Cuts and Jobs Act. And we've got final regulations. So the IRS is going to be focused on that to see how those regs are working and how compliance is working. Related to carried interest is the IRS is generally interested in how the Tax Cuts and Jobs Act is working. So things that change in the Tax Cuts and Jobs Act are a subject of interest in being audited. So that's the qualified business income deduction, 199A. The IRS is particularly interested in people who restructured to take advantage of 199A. Of course, the Tax Cuts and Jobs Act replaced the traditional earnings strippings rule with a general interest deduction limitation in 163J. So the IRS is focused on that. The regulations calculate the interest deduction limitation at the partnership level, which introduces a lot of complexity. So that's going to be a sticky area for partnerships and audits. Conservation easements, it's hard to go a week without reading about a new decision in the conservation easement area. So those continue to be an area of focus. The Wealth Squad, and that sounds like it's my name, but it's not. That's the IRS's name for the squad that is going after high net worth individuals and their related entities. So a particular emphasis on partnerships. Abbey and I gave a speech recently and talked about the Wealth Squad, and somebody asked if they wear capes. And I think the answer is no, but maybe they should. So stay tuned for not only a good name, but also some new outfits for the IRS Wealth Squad. But the IRS is interested in non-filers, particularly non-filers with interest in partnerships. And then, of course, the last one is not unique to partnerships, employment tax issues. So the IRS is always focused on employment taxes because it makes up about 20% of the tax gap. So it's a very material amount. So while not unique to partnerships, it will arise in the context of partnerships, and it's an area of focus for the IRS. Okay, with that, let's jump back into BBA partnership audits, the notices, and what the partnership and partnership representatives should consider doing at each stage of the audit. So I'm going to walk you through the notices and then kind of the to-dos. And this chart I can take credit for. We made this one. I didn't make it quite as patriotic, so maybe it needs more colors, but it is a little bit more streamlined. So the first thing that the partnership, and this doesn't go to the partnership rep, it only goes to the partnership, is the notice of selection for examination, the NOS. So you lost the audit lottery and you have been selected. And there's a couple things the partnership's going to want to consider doing at this stage. One, it can consider changing its partnership representative. And that, or the designated individual, as Mary talked about earlier. And there's a couple reasons you might do that. One, you've fallen out with that person, or that's no longer who you want representing you. Or in the situation that Mary mentioned earlier, if the notice of selection for examination covers multiple years and you have multiple partnership reps, it might be time to consolidate just for efficiency's sake and have just one partnership rep for the entire audit period. The other big consideration at this time is whether you want to file an AAR, whether the partnership should file an AAR, which Abbey talked about earlier. The AAR, of course, is the administrative adjustment request, and it's what the partnership can file if it wants to amend something on its original return. But once you do that, you're in BBA land, right? So the partnership has to calculate its imputed underpayment. But the reason a partnership might want to file an AAR because they lose this ability once they get the notice of administrative proceedings. So it's a short window. But they may want to do that because, as Abbey mentioned, you could push out your adjustments without paying hot interest, and you can make modifications without the IRS's consent required. So if you're a partnership and you know you underreported your income by $100, you get your notice of selection for examination, you've been thinking about filing an AAR, you may want to go ahead and do that, because you can then push out those adjustments without the cost, the normal cost of a push-out election made at the end of the audit of hot interest. So it's an important consideration when you get your notice of selection for examination. Now, anecdotally, the IRS has been receptive to giving partnerships a longer time to file that AAR by waiting to issue the notice of administrative proceeding, which of course makes sense because it extends the statute of limitations. So there's a benefit for both the taxpayer and also the IRS.
Let me interrupt you for 1 second.
Yeah.
You mentioned push out, and we had a question in the chat. Are you advising that the partnership agreement require a push out to prior partners? So any new partners do not suffer the cost of a partnership paying the deficiency. I think I'm a little bit leery about a blanket statement that we would always,
right,
say that every agreement require a push out. Do you have instant thoughts?
Yeah.
On that?
I do. So one thing, I'm going to table that a little bit, but I'll preview it. So we're going to talk at the end about some limitations with the push-out election when you get the wrong result. Kind of conventional wisdom early on with these rules is everybody will push, and push gets it to the right partners. And even though they're paying it in a different year, it's going to get close to the right amount. But there are times when it won't, okay, when it's not to the benefit of the partners. And so our approach in partnership agreements has been to preserve flexibility and optionality. And so we're going to talk some about situations when a push out election is not something you want to require or do, even though it could get you to the right result 80% of the time. Okay, so we're going to keep going. The next notice you get is a notice of administrative proceeding. And this is a big notice in the sense that now you can no longer file that AAR. So it cuts off the opportunity to file the AAR. The other things happening around this time is it really kicks off the audits. You're going to have your opening conference, and that's going to look like an opening conference in any audit. You'll receive your initial IDRs, give me all the books and records under the sun, and tell me about your organization structure, et cetera. And then you can also expect an early statute extension request. And Mary's going to talk a little bit more about this later on, that the IRS has been right off the bat requesting a significant statute extension. Then you're going to go through your audit and you'll develop the issues, you'll respond to IDRs. And then at the end of that, you'll get the summary report where the IRS tells you how they're thinking about these various issues. And at that point, the partnership rep can agree, partially agree, or disagree. And then let's go to the next slide, Abbey. So after that, you'll get the 30-day letter, which of course this kicks off the partnership representative's chance to go to appeals, IRS appeals, and protest the adjustments and the calculation of the imputed underpayment. So to go to appeals, you have to have at least 18 months remaining on the statute. So that's one thing to keep in mind with that statute extension, because you want to make sure that you have enough time. Likely, most people want to go to appeal, so you probably want to make sure you've got that 18 months remaining, so you have that opportunity. After you go to appeals is going to say, where they come out on the various adjustments, and it'll go back to the exam team for the exam team to issue the NOPA, which is going to reflect, the appeals decisions. And the NOPA is significant because it kicks off what Jim talked about earlier, which is the modification process, right? And this is your chance to take that partnership level tax and say it should be modified because this partner's a corporate partner and they only pay 21% tax. It should be modified because that partner's tax exempt and their share shouldn't be subject to tax. And you can bring that imputed underpayment down. Now, 270 days sounds like a lifetime. It certainly sounds like a lifetime for my children. I was telling them they had to wait 270 days for their birthday. That would seem like forever. But it's going to go quickly because there's a lot of information needed. So you don't want to sleep on that period, particularly if you have a tiered structure, because you're going to need to submit a lot of information about each tier. And this, the submission goes through a portal, which we'll talk a little bit about later, because I'll pass along the IRS's big advice for taxpayers out there about all of these rules. It has to do with the portal. Then after the partnership rep submits their modification requests, the IRS will consider the modifications and then give their modification determination package. And this is really interesting because then they say yes or no. We talked about if you file an AAR, the IRS does not have to consent to the modifications. But if you do modifications during the modification process, the IRS has to consent. What's interesting is that then the partnership rep can go back to IRS appeals if they disagree with those modification determinations. So it's unusual to have two bites at appeals, but note that they're completely different in terms of what you can discuss at each one. The first one is the adjustments in the imputed underpayment, and the second one is just modification determination. Okay, after the modification process is closed, you're going to get Jim Dawson's absolute favorite notice in the whole process, which is the final partnership adjustment, because this is your ticket to court. So you get your final partnership adjustment and you file a petition in court within 90 days. And then you also have to make a push-out election within 45 days if you plan to push out the adjustments. Okay, and so with that kind of lengthy overview of the process, I'm going to turn over to Mary to talk statute of limitations.
Yeah, that's a good segue, because as you could tell from Lee going through all of that a partnership audit takes a really long time. So you want to be mindful of what your statute of limitations is. So because of the partnership level adjustment and the imputed underpayment, the statute of limitations is at the partnership level. Unlike under TEFRA, the IRS no longer gets the longer of the partnership or the partner level statute. So there are two periods that you need to analyze that apply when you are analyzing statutes of limitations. Period one is a NOPA, which Lee described. And so how long does the IRS have to issue a NOPA? That has to be issued within 3 years after the later of when the partnership return is due or filed, or an AAR is filed. You might think of that as kind of the normal 3-year statute of limitations. The second period that applies is the period of limitations for making adjustments. And that period depends on whether the partnership will request a modification of the imputed underpayment. If so, then the partnership has 270 days from when the NOPA is issued to submit the modification information, and then the IRS has another 270 days to make adjustments. If the partnership will not request a modification of the imputed underpayment, then the IRS has only 330 days from issuance of the NOPA to make adjustments. So as Lee mentioned earlier, the IRS has been seeking statute of limitations extensions very early on in audits. And the reasoning is that they need additional time to allow for this 270-day period for the taxpayer to make the modification requests. But as you can tell from looking at these two periods we just went through, the IRS is protected as long as they issue the NOPA in a timely fashion. So the taxpayers have a good reason for pushing back on the extension request, but unfortunately the IRS has been pretty insistent. All right, Abbey, next slide. Here we have an example of how the statute of limitations works. So first we have a 2020 partnership return that's due on March 15th. It's filed a few days early on March 1st. So the normal 3-year statute, you would add 3 years to the due date of the return to March 15th, 2024. In this case, the partnership and the IRS agreed to extend the period of limitations to December 31, 2025. So period one, the NOPA has to be issued by December 31, 2025. And in this example, the IRS timely issues a NOPA on June 2nd. So then we turn to the second period, and when is the IRS required to make the adjustments? Here, the partnership will be submitting modifications. So they have 270 days from when the NOPA was issued to submit the modifications. In this example, that 270-day period was extended by 45 days. And so the partnership has until April 13th, 2026 to submit the modifications. And then the IRS deadline then for making the adjustments is 270 days, well, plus 45 days from when the modifications were submitted. So all the way until February 22nd, 2027. So this example highlights that the period of limitations for making the adjustments can expire long after that normal 3-year period of limitations when the partnership return was due or as extended. And this example also shows that the extension periods for submitting the modifications are counted twice. So you can see in this example, the 270-day period and the 45-day period were counted 2 times. First for IRS deadline for making the adjustment. Go on to the next slide, Abbey. The IRS or the statute of limitations that applies now is only the partnership level period of limitations. The IRS has proposed regulations that would allow it to make adjustments after the partnership level period of limitations has expired. If either the partner statute of limitations is open and either the partner controls the partnership or a partner's extended their statute of limitations. And the extension agreement expressly states that the partner is extending the time to adjust and assess tax attributable to partnership related items. I'll go on to the next slide because I think an example makes this point better than makes it best. So here we have a partnership that's a calendar year taxpayer. The partnership filed its 2020 return on March 15, 2021. The partnership did not extend in this period, so the statute expired. Period 1 expired on March 15, 2024, and the IRS did not issue a NOPA. So under the normal rules, that should be the end of the story. But here, under the proposed regs, you would look at A controls the partnership with its 55% interest. So under the proposed regulations, the IRS could still assess the partnership adjustments after March 15, 2024, as long as A statute is open. And for B in this example, B doesn't control the partnership, but B and the IRS agreed to extend B's partner level statute of limitations. And the IRS included in its standard form some language about the extension also extending the period of limitations for making partnership adjustments. So here, the IRS could also assess partnership adjustments after the period 1 had expired, even though the partnership had not extended its period of limitations. So the IRS rationale on the proposed regulations is they need a special enforcement mechanism to deal with tiered structures. But as you can see from this example, there are no tiers here, and yet the IRS still has this big, I say, loophole that they could use to extend the statute of limitations and circumvent it. So Lee testified before the Treasury and IRS on these rules. I thought did a very persuasive job, so hopefully they will not be finalized. But right now it's a possibility. Okay, Avi, I'm going to turn it over to you to talk about, I think bring up the third polling question, which.
Oh, hold on, I'll launch it, Mary, and you can do it, but let me launch it. Here we go.
Oh, well, you might be seeing Avi's to the left over his shoulder there on the left side is, you might be wondering what that is. So what is it? Is it, Avi, is it the University of Texas Longhorns intramural baseball champs of '86 trophy? Is it the home run derby competition among dad's kids in North Texas T-ball league? Is it the softball champs of 2021? Or is it the Golden Glove? First place in a karaoke competition.
All right. I'm going to give everybody, I'm watching the answers roll in.
Not sure I remember what this is for.
Mary's going to be just as surprised as the audience as they learn. Okay, we have a critical mass. In fact, I think our responsiveness might be the best of any of the of any of our polling questions. So here, let me share the results. And Abbey,
It was close. Wow.
it is close.
Okay, so no, it was not home run derby from dads and kids because I don't have big muscles, and no supply chain issues didn't make them give me a golden glove for karaoke skills, which I wouldn't get anyway. It was the one that got the fewest number of votes, the Temple Shalom Brotherhood Softball League Championship Trophy for 2021. So, okay, so not sure how that relates to our segue from statute of limitations, which are scary, to non-income adjustments that result in potential tax liability, which is also scary.
It was levity. Abbey, we're trying to lighten the mood after statute of limitations and before beware.
Yeah, a good idea. So as you can see, non-income adjustments are treated as positive adjustments. That's positive from the IRS's point of view in determining whether there is an imputed underpayment. And non-income adjustments could include adjustments to the partnership's basis and its assets, adjustments to liabilities, adjustments to capital accounts. So here we have an example on the screen where the IRS audits the partnership's 2020 tax year and adjusts the basis of a partnership asset by $100. There are no other adjustments. The $100 is treated as a positive adjustment. It gives rise to an imputed underpayment, even though the asset has not been sold and there has been no realization or recognition of it. So Lee, what is the solution to that?
Okay, you've got three good options. You can amend, use the pull-in procedure to get to the right result. In both cases, there wouldn't be an actual tax paid with that amended return or with the pull-in procedure, or you can push out. And that would also mean no taxes paid. You just take the adjustment into account going forward.
Okay, and you see errors in tax capital accounts, which are now a reporting requirement, could also give rise to an imputed underpayment. This slide is another example on unexpected imputed underpayments with reallocations of between partners. And I think we're going to pass on this one in the interest of time, and we're going to jump ahead to modification requests. And Lee, I think you're up for that.
That's right. And Jim talked about these earlier, so I don't want to spend too much of the time we have left going through the different modifications. I want to flag for you the IRS's big takeaway. We asked at the end of the Federal Bar Association panel, what's your advice for taxpayers in working with these rules? What problems have you seen so far? And their advice was to register for the portal that you have to use to make modifications early and make sure you know what name you registered. So evidently, if you register as, John Smith, and then you try to sign your submission as John R. Smith, it will get rejected. The other thing they mentioned is that the portal will lock you out after 270 days. So you want to make sure, but the IRS will agree to extension. So you want to make sure you've either secured an extension well in advance or made your submission in advance. You don't want to find out on the last day that you are unable to successfully submit your modification request. So with that, let's turn to what the IRS has actually seen in terms of modification requests, because this is interesting. This is from the Federal Bar Association panel, but Abbey is actually on a panel of the ABA in a couple of weeks. And so he may get an even more up-to-date scoop about what the IRS is seeing in these audits. But right now, the IRS, conventional wisdom had been everybody will push. No partnership will pay an imputed underpayment. Partnerships don't want to be taxpayers. But what's interesting is the IRS has seen more modification requests than push-out elections. And partnerships are paying the imputed underpayments. They're able to get the imputed underpayment to an acceptable amount through the modification process, and then are choosing to pay it rather than force their partners to amend returns or take into account the adjustments on their current year return in a push-out election. Okay, the most common modification request, and this one's really interesting to me, rate modifications is no surprise. I think we all expected rate modifications to be common, but amended returns are the second most common, or actually I think probably the first most common. And that one's surprising because you'll hear in negotiations a partner or investor will say, I want a side letter agreement saying that you'll never ask me to file an amended return. But because an amended return is a good way to get to the right result, and there are times when that's the best way for a taxpayer to take advantage of a benefit from that results from the audit, amended returns are a very common modification request. We already talked really about how to request a modification. The only other thing I'd flag here is that tiered modifications are particularly complicated because you have to prove up each level, the allocations in each level of the tier. Okay, and with that, I am going to turn it over to Jim to talk amended returns.
All right, thank you, Lee. So this slide addresses the amended return modification request. The reviewed year partners can reduce the imputed underpayment by filing amended returns and paying the tax due during the 270-day period for modifications. Amended returns are really the only option to be sure that the correct partners pay the correct amount of tax. Note that partners can file amended returns even if the statute of limitations is closed. However, this is a one-way street, as we shall see shortly. Okay, there are some limitations to the amended return modification request. The partner's amended return must be filed before judicial review of the adjustments. A partner cannot be compelled to file an amended return. If a reallocation, let's say income, as we've been discussing, for example, all affected partners must file amended returns. So let's go to an example about the amended returns. If we go to the next slide. All right, so on this one is partner files a 2019 return on October 15th, 2020. So the limitation period, of course, is 3 years out. The IRS proposes to increase the partnership's 2019 income by $1 million. Partner files an amended return on 6/1/22 as part of the modification process, pays the taxes. So 2-year period from the date of payment runs on 6/1/24. The PR, however, files a petition and prevails in November of 2025. Here's a caveat. Unless the partners file the protective claim for refund, the partner will be unable to recover the amounts paid when he filed that amended return and paid the taxes on June 1, 2022. That is, there is no tolling during the judicial proceeding. So here's a practice tip. Make sure that the partner when he files the amended return modification, should also file what's called a protective claim for refund before the 6511 statute of limitation expires, if the partnership representative is contesting the adjustment in court. All right, so next slide. So this slide compares the amended return modification request with the pull-in procedure. An amended return modification request and the pull-in procedure are similar in that the partner calculates and pays additional tax, penalties, interest at the partner level, but there are some differences. The pull-in method provides an alternative to modifying an imputed underpayment by not filing an amended return. In theory, the pull-in method should, in theory, have the same effect as the filing of amended return. However, there's very little guidance on the pull-in procedure right now, particularly how partners make binding changes to their tax attributes for subsequent years. Our understanding is that no one is using the pull-in procedure, and for that reason, we will move on.
Thanks, Jim. Well, the IRS is penalty happy these days. So if you are audited, you will likely face a penalty. So this slide shows something that may arise that we just wanted to flag for you, which is the IRS is going to look at whether a partnership has an understatement of income and proposing a penalty. If the partnership has an understatement of income, but at the partner level, there is no understatement because the partners have losses, what happens? Well, the big upfront point to take away from this is that the partnership should not just pay the penalty on the imputed underpayment. There are several ways to get to the correct result, including having the partners file amended returns or use the pull-in procedure during the modification period, or the partnership can make a push-out election. And then the last point I wanted to make on penalties is that if a partner has a reasonable cause and good faith defense, the partner would have to pay the penalty and file an amended return. and then file a claim for refund of the penalty of Form 843 because the reasonable cause and good faith defense is a partner level defense. Lee, I'll turn it over to you with a few, well, it's noontime, to talk about the Pushout election.
Yeah, so I'm just going to highlight these because this question was earlier, which was, are you all requiring the Pushout election to be made in partnership agreements? And we said, no, we preserve flexibility. And here's really why. So there's limitations with the Pushout election. Number one, it's difficult to comply with the deadlines in tiered structures. So you're likely in tiered structures to have some partnership or flow through entity in the tier kind of stuck with an imputed underpayment because they don't have sufficient time to issue the statements. The pushout is unavailable if there's no imputed underpayment. So if you have a reallocation of income from one year to another, the year where there's a reduction in income, a pushout election is not available for that year. So to get the benefit of that or reduction, you'll want the partners to file an amended return. There's a cost, which we talked about earlier. You have to pay hot interest. Another big limitation is there's no benefit from carrybacks to years before the reviewed year. So if you have an NOL or a loss that gets allocated from one partner to another partner, and that partner is obligated to carry it back before the reviewed year, that carryback and benefit is not taken into account in determining the reduction in tax for that reviewed year partner. So that's a big limitation for that reviewed year partner. Another big limitation where you wouldn't want to be stuck in this situation for the partner is that your refund is limited to the tax paid in the reporting year. So if when you look at the push out and you recalculate, you paid, in the audit year, you paid $10,000 in tax, and based on the adjustment, you should be entitled to a $5,000 refund. But the reporting year, you only paid $2,000 in tax, then you can only get a $2,000 refund. And that basically converts the adjustment into a non-refundable credit, and you lose the benefit of that $3,000. There's a Green Book proposal to fix this, but we'll need a change in the statute for this to happen. So stay tuned there. But the Pushout election, the big takeaway is it's not the perfect solution. And with that, I'll turn it over to Mary to wrap us up with our last poll.
Yeah, but first, before I do the last poll, Lee, can you remind us how we get how people get CPE credit?
CPE credit, I do not. I think you fill out the survey, or no, I think you self-report is the way CPE credit. If Bonnie's still on, then
okay, well, we can follow up with that afterwards when we send out the slides. So let's do the last polling question. So which is the largest Holland and Knight office? Miami, Dallas, Washington, D.C., or New York City?
All right, the answers are pouring in. We might have an East Coast audience today. All right, I'm going to go ahead.
Surprised. Yeah.
For the sake of time, I'll go ahead and end the poll and share the results. There we go. And Mary?
Yes, Dallas with 202 attorneys. Yeah, so we rule. Sorry, Jim Dawson and the East Coast. But it's close. We have large offices in Miami and Washington, D.C. and New York City, but Dallas is the largest. So thanks very much for joining us today. We're happy to stay and take questions, but certainly understand if you need to run. But feel free to call or email us at any time. Thanks again for joining us.
Thanks, everybody.